So what is a 30-year fixed mortgage? That is a fantastic question, especially if you're in the market to buy a new property. But what exactly is a 30-year fixed mortgage? What exactly does that mean? Okay, we're gonna break that down and we're gonna discuss some of the pros and cons of a 30-year fixed mortgage in today's video. Hi there, this is Mike Adams with Bankrate, where our goal is to guide you through life's financial journey. And as a heads up, we did a fully detailed blog article on this exact topic that you can find on our website over at bankrate.com. And while you're there, make sure to check out the all-new Bankrate dashboard. This is a free service that allows you to access additional articles, calculators, pre-qualified offers, and more, all in one place based on your specific interests. So if you're interested in that, again, you can check it out over at bankrate.com or by clicking the link in the description. In short, a 30-year fixed mortgage is a loan, okay, typically between you and a bank. And typically a mortgage is going to be used to purchase a piece of property. So if you're in the market to buy a home, chances are you're going to be taking out some type of a mortgage to purchase that property. And so a 30-year fixed loan is a very popular option for many people. So when we talk about 30 years, that is the term of the loan. So that is the length of the loan, meaning you will make even monthly payments. And if you were to make every single minimum payment, it would be over the course of 30 years that you would actually pay off that loan. Now, when it comes to fixed, that's speaking about the interest rate. So every loan that you will get from a bank is going to have some type of interest rate. And an interest rate is essentially the charge that the bank is charging you to lend you that money. Interest is one of the ways that banks make money on giving somebody a loan. And so as you send in these payments over the course of 30 years, some of that payment will be principal, meaning you're knocking down the balance of the loan, and some of that payment will be interest. Now with a 30-year fixed loan, that essentially allows you to lock in whichever interest rate you qualify for when you get the loan. So you'll be able to maintain that interest rate for the duration of that loan. Also, with a 30-year loan, the payments are going to be what's called amortized. At the beginning of the loan, they don't charge you all of the interest up front. What they do is they amortize or spread out that interest over the course of the 30 years while you'll be paying down that property. So when you send in your monthly payment, some of that payment will be principal, which again knocks down the balance of your loan, and another portion of that payment every month will be interest that goes right to the bank. Now, at the beginning of your loan, you'll notice on your payment, a higher percentage of your payment will be going to interest because again, they are trying to spread that out over 30 years. So at the beginning of your loan, a higher percentage of the payment will actually be going to straight interest, and a small portion of your payment will be going to knock down the principal balance of the loan. Over time, and at the end of your loan, when you make the very last payment, a very high percentage of that payment will be principal and a small portion will actually be interest. So it evens out over time to spread out or amortize that interest over 30 years. So now, is it right for you to get a 30-year fixed loan? Well, that certainly depends on a multitude of factors. So let's take a minute here to talk about some of the pros and cons of a 30-year fixed mortgage. One of the biggest pros is that this is what's going to allow you to get the lowest possible monthly payment. So if that's a big factor for you, because you can get a mortgage that's amortized over 20 years or even 15 years. However, if you're wanting to shrink the term of the loan, the payments month to month are going to be much, much higher. So by taking out a 30-year fixed loan, you can actually have the smallest possible payment every month for your mortgage. When it comes to the rate, and you do have an option to go with a variable rate loan, one of the beauties of a fixed rate is you get additional stability. Every single month, you're gonna know exactly what your monthly payment is. And you'll know that right when you get the loan. You'll receive an amortization schedule, which will show you every single payment over the course of the 30 years, how much of each payment will go to principal, how much of each payment will go to interest, but you'll know exactly how much your payment amount is for the duration of the term, which is fantastic. In some cases, this will actually allow you to buy more house. When you go with that 30-year, again, you're getting a smaller monthly payment in comparison to taking out, let's say, a 15-year mortgage. And so in that case, you may be able to afford slightly higher than a 30-year mortgage payment. So that might actually allow you to buy a larger home. And also a 30-year fixed mortgage certainly gives you the most wiggle room. Again, your payment will be the smallest based on this length of term. So when it comes to factoring your monthly budget, this one certainly gives you the most wiggle room. Now, a couple of the cons of a 30-year fixed mortgage. The number one con is the fact that you're going to pay quite a bit of interest over the course of 30 years. Because of the fact that you are amortizing the loan interest over 30 years in comparison to, let's say, 15 years, simply put, number one, it's going to take an additional 15 years to pay off the property. But number two, you will end up paying more total interest over the life of the loan in comparison to buying the exact same property with a 15-year mortgage. You'll pay less total interest by comparison. 30-year mortgages are also subject to slightly higher interest rates than, let's say, a 20 or a 15-year mortgage. Simply put, because the bank is taking a little bit more risk by giving you such a long time to pay them back. Because of that perceived risk, the bank is going to charge a slightly higher interest rate on a 30-year mortgage. One con to definitely be aware of is you definitely don't want to become what's called house poor. And this is where you go with that 30-year mortgage because you can get a lower payments. That means you can buy more property. But now a lot of your money is tied up inside of that property. Just because you can get more home because you're taking out a 30-year mortgage instead of a 15 doesn't mean that it makes sense to overstretch your budget to where you truly become house poor. And finally, you're going to deal with slower equity growth. Because of the fact that this loan is amortized over 30 years, at the beginning of your loan, especially those first couple of years, the majority of your payment is going directly to the bank in interest. So you're not knocking down the principal by very much in those first couple of years. And so the equity in the property, if that's something that's very important to you, it's going to go a little bit slower in a 30-year mortgage than it would with a 15-year mortgage. So is a 30-year fixed mortgage right for you? Well, that certainly depends on you and your particular scenario. Again, over on our website, bankrate.com, we did a great article on this where we will literally show you all the different types of mortgages that you could get to make your property purchase. And you can compare them side by side. So again, if you want to see that comparison, that chart, you can see it inside of the article over at bankrate.com. There will be a link in the description. And one thing that I would leave you with regarding 30-year fixed mortgages, over time, your credit can change, your financial scenario can change. And if you got a mortgage, let's say a couple of years ago, and now your credit's gotten better, or your income has increased, or things have just gone positive in your financial scenario, you may be able to consider refinancing your mortgage, and from there, getting a lower interest rate, which can save you quite a bit of money in interest over the life of the loan. And as well, potentially even lower your monthly payment, which would increase your monthly cash flow. Now, on the flip side of refinancing, a couple things to consider. Number one, there's going to be fees associated with originating a new loan. But then as well, you are also resetting the clock as far as the amortization schedule. So hopefully you guys found value in this training and in this discussion. If you did, make sure to give this video a like and give it a comment below. As well, please subscribe to this YouTube channel. We're going to be coming out with a ton of great content to help you on your journey to financial freedom. And as well, for more great articles and training just like this, make sure to visit us over at bankrate.com.